Good, okay, we'll make a start then. Good afternoon, welcome to this Policy Exchange event on regulatory reform. Thank you all for coming. Good to see we have a packed room, still a lot of interest in financial reform. The topic for discussion today is purposely broad. Has financial reform fallen short or has it gone too far? And the reason it's broad is because there's a lot going on. And we've reached quite an interesting point in the debate, I think. 2 years ago, a year ago, there was huge heat in this debate. There was a lot of political pressure to come up with ideas for radical reform of the system. Now I think we are at a different interesting point in the debate where things are now starting to be done. Basel III has been agreed. The government have a commission on how we get to incentivising a more boring form of banking. The FSA in Europe are looking at different forms of reform of remuneration. So a lot is in motion. And at the same time, even after 2 years of these debates, it sometimes seems like we don't really have a very clear sense of what we're trying to get to, or even a particularly clear diagnosis of the cause of the financial crisis. So, a lot of moving parts. We are very fortunate today to have an extremely high-powered and distinguished cast of characters to discuss these things with you. I'm going to have some speeches from the panel, and then we're going to have questions and answers at the end. Starting from left to right, Joanna Elson is the Chief Executive of the Money Advice Trust. She was previously the British Bankers Association. She's the Vice Chair of a financial inclusion charity called Transact. She also advises the Treasury about financial inclusion. She's also involved in poverty alleviation. Dan Mobley is Head of Government Relations at Standard Chartered Bank. Standard Chartered very kindly making this debate possible today, for which thank you. Previously, he was at the Treasury for 8 years. He was in Brussels, so he can talk to us about the European dimension. And he was also Private Secretary to Nick Macpherson, which must be interesting. Laura Burt does not need really any introduction whatsoever. She's been the chair of this party. She's been on the Treasury Select Committee. She's been Shadow Minister for Business. I didn't know that she'd previously been the Assistant Governor of a prison, which is quite a change of career.
I'll keep them in order.
I'm sure that's extremely useful in Parliament. And last but absolutely not least, Patricia Jackson is a partner at Ernst & Young. She advises on capital, liquidity and stress testing, which must be interesting at the moment. She was also a member of the Basel Committee. She worked on the development of Basel II, which is obviously a very interesting thing to know about. And she was head of the Bank of England's Financial Industry and Regulation Division. So very, very distinguished group of people today. We're going to start, if that's all right, with Joanna. So over to you. Thank you for coming.
Thank you very much indeed. I was musing as a mother of three about what I could say about babies and bathwater, and then various things have happened. You know, we've got David Cameron and baby Flo, and then I saw this bit in the papers over the weekend, which was Charles Kennedy talking about not throwing the baby out of the bathwater and coalition cuts. But anyway, enough of that. 4 things I wanted to talk to you about. One is why you might be interested in what I've got to say, what our credentials as the Money Advice Trust are to have a voice on this topic, because essentially we're the sharp end and the voice of the consumer. Secondly, how complex the current regulatory system is and why that's important. Thirdly, how we can make it more effective, and then just a couple of thoughts really to finish off with. So if I can speak first of all about our own credentials at the Money Advice Trust. We help several 100,000 people every year who are in financial difficulty. We run the National Debt Line and Business Debt Line, and those people are people who have experienced financial services at perhaps the worst end of it, and so regulation is important to them. The Trust also has a strategic role in bringing together government, creditors and advisors to come up with innovative ways of both helping people through the crises in which they find themselves and then keeping them financially healthy. And I think there's a link there with financial regulation we might want to explore. And then the final point I wanted to make there was that our focus is very much on assisted help, assisted self-help, about helping people to help themselves, and how regulation interplays with that is important too. So let's look at that then. How complex is the current system? I'm going to hold up a chart for you which is something that we produce in our role training money advisors as to how to help people. Now this one is just about mortgages, it's not about unsecured credit, and that is what advisors need to refer to when they're advising their clients. You can see, you can't read the detail, but you can see it's a pretty complex picture out there. And actually what that means in practice is that it's more difficult for individuals to help themselves, because would you want to negotiate all of those different aspects if you didn't have the technical know-how to do so? It makes it more complex and lengthier for an advisor to advise someone, and it means the training we give to those people has to be lengthier and more complex. So all of those are reasons why you won't find me arguing for more regulation, but you will find me arguing for better and more effective regulation. So let's turn then to how we can make regulation more effective. I think there are three ways. We can simplify it, we can build on what works, and we can police it. So let's look at simplification first of all. One example I wanted to use with you here to explore why it is that simplification is important is based on the fact that often consumers simply don't understand, and why should they, the complex set of regulations that sit behind something that sits on the statute book. So let's take an example. If you have a mortgage and you're a consumer, people who come to us don't necessarily understand whether they have a first or a second charge mortgage. It's a mortgage. So therefore they don't understand what protections are available to them. So a simple thing that could be done would be to ensure that the regulation that affects first and second charge mortgages are the same, that you have the same regulator, that you have the same protections, that everybody has access to the Ombudsman service, which of course you don't if you have a second charge or secured loan currently. So that sort of bringing things together, making it simpler, surely would improve things for consumers, and it might just improve things for companies as well. They might have a few less difficult decisions to make. So that was my simplify point. The second point was build on what works. So if you cast your minds back, some of you might remember, about November 2008, Peter Mandelson called together a number of organisations, both in the credit sector and in the advice sector. He was it was on the credit card side, in fact, he was trying to ensure that as the downturn bit, as it were, there was a breathing space for people with financial difficulties. So they got 30 days to put their house in order and ensure that they could then find the help they needed and so on. That little bit is enshrined in the sense that all credit card providers now do that, and it's starting to spread to other sectors. But actually, wouldn't it be more straightforward if where you have a provision like that works, that works across all of the different sectors? So we'd like to see things like that applied to utility companies, to when government collects tax, and so on. So my second point is build on what works. And my third point is police it. If you've got this regulation, you've simplified it, you've checked it works, then police it, because otherwise, what's the point of having it? If you talk to the Office of Fair Trading, they have recently been doing a review of fee charging debt management companies. They haven't published that, but they've told me and they've told lots of people that what they found was 100% non-compliance with their own rules. And yet, they will say they haven't got the resources to do anything about it. In the current climate, I think it's unlikely they're going to get more resources to do anything about it. So isn't it then about making the policing of it smarter? So let me give you an example of that. If you're the OFT and you try to start enforcement action against, say, a fee charging debt management company, that company can spin out for years and years the process, because there's a complex and lengthy appeals process. Wouldn't it be sensible, in this instance, to introduce a simple, cost-effective and time-limited process whereby everybody knows when the action has to stop? Because at the moment what happens is that these people just keep trading during these months when the investigations are being carried on, their appeal is out there, and it doesn't work for the OFT. Clearly, it doesn't work for the people who are the victims of this. The only organisations it works for is the people who the OFT are trying to prosecute. So, finding ways of making the policing of regulation more effective in the absence of likely lots of extra funds, I would suggest is a sensible way forward. My last point then, I said I'd just leave you with a couple of points. Often it seems to me that effective regulation comes down to hearts and minds, doesn't it? And regulators and other stakeholders in this area have a decision to take often. You know, are they going to go for a box-ticking exercise with a book of rules that compliance officers can tick down and say we've done all that, or are they going to go for a hands-on heart statement that the senior management of a firm makes and says yes, we will treat our customers fairly? It seems to me that actually you need to be able to achieve the two, and you need a balance between the two, and you need a pragmatic balance. And it seems to me the way you get that is that you set out by being absolutely clear about what you as a regulator want to achieve. So if you take Basel III, which obviously sort of great interest to people now, the three questions it seems to me that need to be asked about it is, what is it trying to achieve? Can it do that in a counter-cyclical way so it can survive the peaks and troughs? And thirdly, what might the unintended consequences be? Can you avoid those? So I was at a fringe this morning where a number of the building societies were saying, well, the trouble with Basel III is there's no instrument that works for building societies, so they're going to have to hold a lot more capital than we as a society might otherwise want to, and so on and so on. So those three questions about what you want to achieve, will it work, and can you avoid unintended consequences, seem to me the ones that we should all be asking. Thank you.
Thank you, Joanna. Very interesting stuff on consumer protection. Dan, I think he's going to talk a little bit more about the macro picture. Dan.
Thank you very much, Neil. I just think I should apologise to Joanna for our slightly wobbly banner behind her. I promise you it's not a metaphor for the bank Standard Chartered. It was wobbling away. So I should just start by saying that Standard Chartered may not be very familiar as a bank to many of you. In fact, we're often, for lots of British people, the largest company in Britain that you've never heard of. I was very, very pleased that the Liberal Democrats decided to hold a party conference here in Liverpool, because one reason that people in Liverpool might know us is thankfully we are sponsoring their wonderful football club, and we've got the Standard Chartered logo across there, something we're very proud of. But I make the point that we're not well known, because what are we as a bank? Well, we're actually a very large international bank. We have 80,000 employees. We operate in almost 80 countries worldwide. The vast majority of those are in Asia, Africa, and the Middle East, so in the emerging markets rather than the industrialized worlds. And I think that's important for this topic because really for two reasons. One is we have been perceived to have had a good crisis, if that can be said, in that we've remained profitable throughout. We didn't take any public money. We didn't get involved in subprime mortgage lending. We didn't get involved in complex structured finance that lost lots of money. And one of the reasons is because we were operating in Asia, Africa, Middle East rather than in the Western worlds. And so, I think it's quite important to get across there's a need for policymakers here in the West to show a bit of humility. There are lessons to be learned from these emerging economies that we should pick up, and we should think about why banks failed in certain parts of the world and did not fail in other parts of the world. Understandably, at the moment, there is a lot of public anger towards banks and bankers. We saw quite a lot of that at conference yesterday in Nick Clegg's speech. We've seen it in some of the comments that Vince Cable is making. And it's quite right that the public is furious with the industry as a whole. I think we haven't yet reached the point where the industry collectively has sort of shown responsibility for what's happened and the harm that it's caused in the UK and other parts of the world, and recognise the fundamental need to change and restructure how we operate. But I think there is a risk in the totally understandable desire to punish the banks and punish bankers, that we slightly blind ourselves with fury about what the fundamental questions are that we need to address. I argue, one, we need to think through very carefully what role we want banks to play in society and in our economies. Second, we need to think very carefully how we ensure we don't have a devastating crisis like this one again. And third, how you can actually make banks part of the solution and not the problem in future. And I don't think we're yet drawing the right lessons from this crisis to answer some of those questions. I think we're still probably a bit too embroiled in the pain and the desire to blame people. And while that is something that must be done, we need to now start thinking about how we move beyond it. I mentioned earlier about taking lessons from those parts of the world that haven't experienced a financial or banking crisis. I think that's quite important. You hear the phrase the global financial crisis a lot. I think that's quite sort of West-centric. This wasn't a global financial crisis. This was a crisis in the US. This was a crisis in Western Europe. But actually, you didn't see systemic banking failures in Asia, in Africa, and most of the Middle East. So in those markets where we operate, you didn't see banks taking fistfuls of taxpayers' money. You didn't see them falling over. There was a liquidity squeeze. There was a very painful recession in many of these countries, although they're now bouncing back sharply. But that was a ripple effect from what was happening in the West. It wasn't a financial crisis in those emerging economies. And the primary reason for this is because Asia had already had its financial crisis. It had it in the late 90s. It was extremely painful, and in many ways it was a miniature version to what's happened in the Western world over the last couple of years. And Asia learned the lessons from that financial crisis in the late 90s, and it changed. And Asian banks, and that includes large Western international banks like us, who have big operations in Asia, learned some important lessons. And the four I pick out is we don't run very leveraged business models. You don't see the kind of things that you saw with, say, Lehman Brothers, where they were running incredibly leveraged books. Asian banks tended to avoid overly complex products. It wasn't Asian banks selling CDO squared and CDO cubes that seemed to lose so much money. They were instead just focusing on their customers, both their retail customers and their commercial corporate customers, the people that they knew well. They didn't lose sight of the basic disciplines of banking. They focused on managing their liquidity, on managing their risk, and managing their capital, and not all Western banks did that. And we also saw different behavior from regulators in Asia. They are very tough supervisors in Asia, much tougher than perhaps we've seen in the UK or the US or parts of Europe. They will actively intervene to prevent asset bubbles arising. They will actively intervene when they believe they see systemic risk. So while I wouldn't pretend that Asia got absolutely everything right as a result of their reaction to their financial crisis, a lot of what they did has worked, and we in the West need to now learn from that. I think it's just worth pausing and thinking, why did banks fail? I think there's three things we should probably look at to help us draw some conclusions. I think obviously poor management, and we hear a lot of talk of that. There were unfortunately some boards and some CEOs of banks who simply underestimated the risks they were carrying, and I think got caught away in their own prowess and their own ability to manage their banks through difficult times. But also, and this is something that's talked about a little less often in the media, particularly by politicians, we need to talk about macroeconomic policy. Where banks and banking systems failed, we had very, very loose fiscal and monetary policy. The crisis originated and was very much worse in those areas where people had basically borrowed too much, too cheaply. And that wasn't just banks, although it was banks. It was also people, it was non-financial companies, and it was governments. They were borrowing too much and they were over-leveraged. And the third thing we saw in the West was often very weak supervision. There was definitely a failure of supervision. Often supervisors were simply focused on the wrong things, and they weren't really focusing on the bigger picture. But when we talk about why banks failed, I think it's also important to think about some of the things that took place that didn't make a difference, that didn't prevent the crisis from happening. I think it's important to note a few of these. I mean, one I would say is, if you're looking at things that frankly didn't make a difference in the last crisis, was the structure of the regulatory authorities. Whether supervision, supervisors, and central banking was combined or separate didn't matter. There were some countries where banks collapsed where the two were separate. There were some countries where banks collapsed where the two were together. So I think things like this idea to merge the FSA and the Bank of England, it may be a good reason. There may be, good reasons for this, but we shouldn't pretend that that's going to somehow prevent future crises, because our lesson from other countries is it didn't. I think regulatory constraints on the structure, scope and size of banks, this debate versus narrow banks and casino banks that you hear a lot about, I'm afraid it didn't make the slightest difference. We saw some small retail banks failing. We saw some separate investment banks, call them consumer banks if you like, failing, and they were completely separate. And they both had system-wide impacts, whether it was Northern Rock, the start of the financial crisis, or Bear Stearns, one of the first large banks to go down. So there's just no evidence, and no one's come up with any evidence, that combining retail and wholesale banking activities played a meaningful role in causing the crisis. And actually there is some evidence that large, broad-based universal banks fared better rather than worse through this crisis. Unfortunately, the details of the regulatory frameworks themselves didn't seem to make a huge amount of difference. Whether banks were following Basel I or Basel II didn't appear to make a lot of difference when you look at those that went down and those that didn't. And even capital ratios appeared to have only made a relatively marginal difference. Many of the banks that failed were very strongly capitalised. Now, this is not to say we should have undercapitalised banks, that would also be a mistake. But actually, it was liquidity in this crisis which received very scant attention from regulators, which many bankers took for granted, that proved much more important in determining who fell over. But unfortunately, when we look at the policy debate, whether it's here in the UK or in Brussels or in the US, where is it focused? Well, actually, at the moment, it seems to be largely about capital levels, about breaking up banks, about the structure of regulation. And those, like I say, were the things that when you look internationally didn't seem to be the most important. And we're spending a lot of time collectively, whether it's banks, politicians, regulators, arguing furiously about these things, but we're neglecting some very important things. So what would I like to see? What would be on my wish list of changes that either isn't been done or has not been done enough? Well, I think it's great that we got agreement on Basel III and on capital levels and on liquidity arrangements, and that hopefully will be much better managed and regulated going forwards. We need to think very carefully about how we manage the kind of interaction between macroeconomic policy and the banking system, what's now often being referred to as macro-prudential regulation, system-wide regulation. Now, this has been going on for quite a long time in Asia. It seems to have been slightly discovered a little bit by some people here in the West. Asian policymakers have long been using things like loan-to-value caps, so capping the size of the mortgage you can take out. And I can tell you, if you try and sell, for instance, a mortgage in Hong Kong above 80% loan-to-value, your regulator just will not allow it, and you will get absolutely clattered if you try and find a way around it. And that's been a very useful way of sort of mitigating real estate bubbles in Asian countries that have operated this. So it's great to see that this government has announced it's going to create this financial policy committee in the Bank of England, which will do macro-prudential regulation, but it's very unclear what tools it's going to have and how it's going to do it. The second thing I'd like to say is, we hear a lot of talk about too big to fail, that there are some banks that are too big to fail. I think the answer is no, it's not to try and make banks smaller, because we saw in the crisis small banks fell over with dramatic results as well. But it's to design a system that enables any bank of whatever size to fail without imposing costs on the taxpayer. When a bank falls over, it shouldn't cost us as individual taxpayers any money. And also that it shouldn't trigger contagion and knock over other banks like a set of dominoes. So part of this is about ensuring banks can be dismantled in an orderly fashion, and you might have heard the concept of the living will being bandied around, which sets out how you would break up a bank in a crisis situation. We strongly support this. I think it's a great idea. It's being trialled here in the UK. We think other countries need to introduce it. I love the phrase of living will as well. It's like, I keep telling my brother that, should I pass away, I will leave him several $1 billion of toxic debt. But it's quite an important concept. I'd also say that, it's quite important that we define how banks could be recapitalised when they're in trouble without going to the taxpayer to have to do it. And this is where ideas like the bail-in that you may have heard, where actually sort of forcing the creditors of the bank to actually put money in and recapitalise it so it doesn't fall over, could be really useful, and we need to explore that properly and look how we can introduce that. We don't yet have a framework that would allow that kind of intervention. And one last area that seems to have got a little bit forgotten in this crisis is the role of the ratings agencies. It's a little bit personal for us at Standard Chartered, because pre-crisis, for many years, the ratings agencies would turn around and say, we're rating you quite poorly because you're in these terribly risky countries like China and India, and wouldn't it be much better if you had a nice safe place like the US to call your home, which is interesting in itself. But what we found is there's just a severe conflict of interest in the way the ratings agencies operate, and everyone's a bit scared to talk about it because, banks don't want to talk about it because the ratings agencies rate them. I mean, because they've been so mean to us, we don't mind being mean to them. But ratings paid for by the issuers, you've just got to create a conflict of interest, and they actually undermine investor discipline. Why would you do your own homework? Why would you take accountability for your investments if you've got the ratings agencies sort of guaranteeing them for you? So I suggest we just ban issuer-paid ratings for structured credit products. Just ban them. And I think that would instantly increase transparency and market discipline, and it's something that's not being talked enough about. Last thing before I wrap up, sort of desperate plea that while we move forward on all this stuff, we do it internationally rather than unilaterally, and obviously a lot of banks are saying this, but there's good reasons for that. We need coordination and consistency, because if you don't get it, what you'll see, frankly, is regulatory arbitrage. You will see banks playing games between different jurisdictions to get round to any new rules that are brought in. And we saw in this crisis that bad banking practice can drive out the goods, and we don't want to see that opportunity for arbitrage. It needs to be done internationally. And a good example of that is on bonuses. We really support what the FSA is doing on bonuses, the ideas of clawbacks and deferring pay over a long time, banning guaranteed bonuses for multi-years. People getting 2-3 year bonuses when they're hired by banks. The problem is the UK is the only country that's done it. And for a bank like this, it is infuriating when you look in a market, say like Singapore or Hong Kong, and our staff are being poached because our American competitors or some of our European competitors are paying 2-3 year guaranteed bonuses to steal our staff when people are walking. So we need international consistency in this area. So in conclusion, banking clearly needs reinvention. We need better regulation, we need better management by the banks of their own banks. We need to return to subordinating the financial system to the real economy. So we see banks supporting growth and job creation as we go into the recovery. But let's not pretend that improving regulation of banks will actually guarantee a safe financial system. I'm afraid a lot of this debate, we see banks and bankers being seen as absolutely the crux. And I'm afraid we're just less important than we bankers like to think we are, and we're less important than you guys like to think we are. We need to rethink through fiscal and monetary policy if you're to avoid future financial crises. So don't just assume that regulating the banks will get us out of this. It's a necessary condition, but it's not sufficient. And I would just say that the kind of long boom that we saw pre-crisis, what many people call sort of great moderation, I mean, it obviously wasn't a great moderation of the global economy. It was a great binge. And what you saw were banks being very enthusiastic participants. They were plying everyone with cheap credit, including other banks. But you also saw companies and individuals and indeed politicians in government drunk on this low interest rate environment and the belief that stable growth would go on forever and that liquidity would always be there, and that was a terrible mistake. So sort out the banks is very important, but don't think that's enough. We're kidding ourselves if we ignore the facts in the recent history.
Brilliant, thank you, Dan. And that is an extremely well thought through manifesto for reforming the whole system. Without further ado, over to you, Laurelie.
Thank you very much. Much of the claimed overall benefit of regulation is no more than bread and circuses, giving attractive rewards to citizens and penalising productivity in the process. Not my words. This is the executive summary of the British Chambers of Commerce regulation report from 2010. And well, you can tell that the British Chambers of Commerce think that there's far too much regulation, and that every year they produce this chart, and the cost of regulation to industry goes up and up and up, and I think it was about 77 billion the last time I looked. I mean, it just seems a little bit over the top to me, because we do need regulation. Business needs regulation. The Labour Party legislation was about to be enacted. It has been estimated that the cost of introducing that would be £11 billion now, and it would be £19 billion a year by 2014. So that's a lot of money. Business needs to have a fair playing field. I want to talk a little bit about banks specifically, but then I'd just like to conclude my remarks with your permission on what the government's doing about regulation generally. My own background in this is I'm a veteran of the last government's regulation reform committee. And it is a committee which was just about as exciting as it sounds. And we used to tinker around on the edges of regulation, and it really used to frustrate me, because what I thought is, we really do need to just get regulation, simplify it, get it by the scruff of the neck. And what's really nice is the things that are being announced now are all the things that Laurelie has been saying for years. So we're actually getting there. We're in charge. That's fantastic. I just want to talk about the banking crisis. I feel a little bit timid about doing this, given the wealth of knowledge and expertise in this room. So I'll just give you a politician's view, really, of what happened. Was the banking crisis caused by insufficient regulation? I don't think so. I think that the Financial Services Authority didn't do their job. And this is the problem. Whenever you create a watchdog, unless it actually does its job, you know, not only barks but uses its teeth, then, you know, people just aren't going to take any notice of it. And I think, you know, the circumventing of a lot of the rules, they should have been a lot more on the ball. And we've had in the last Parliament the Better Regulation Executive, and they came before my committee and they said how good the FSA were now and how hard they were working, and the FSA said how good this watchdog was and everything. I think, hang on a minute, this can't be right. You know, this is all sort of motherhood and apple pie that we're getting here. So Vince's comments about changing the structure of banking, which he made before the general election, and taking separating the retail arm of banking, which is the general transactions that you and I do all the time, and the investment arm, which is more risky, has been described as the casino arm of banking. That seems like a very good idea, but now we're in government, we do have to test that out. Because what would be tragic would be to say, oh, that's a good idea, and not implement it without really thinking through the implications of what we're going to do. So, as far as financial regulation is concerned, the Coalition have set out their plans to put the Bank of England in charge of financial regulation. The changes are that it's going to create a new financial policy committee within the Bank of England. The bank will be the top regulator in the new system, and it creates two regulators under it. The first is called the Prudential Regulation Authority, which is regulating banks and other financial institutions. And the second is called the Consumer Protection and Markets Authority, which also creates a single agency to tackle economic crime. Now, I just have a twinge of anxiety about that, because what we don't want to happen is activities which fall between those two separate authorities. So again, it's very important, I think, that we just keep an eye on what's happening there. So just coming back to regulation generally, regulation is important, and when great comments are made. But I remember Michael Heseltine was a great big piles of red tape, physically there, and we're going to sweep all of this away. And it's actually very, very difficult to sweep away regulation, because it was introduced generally in the first place to achieve a job. And so I put out a challenge to business in the last Parliament, and I said, come then, any regulation you would like to get rid of, tell me, and we'll lobby the government, that's no problem. And they couldn't think of any. Well, they could. It was maternity legislation. They didn't like that. I said, well, I'm very sorry, but that stays. So it is hard, and as soon as you go to cut a piece of regulation, whoever it's intended to protect is going to have something to say about that. Anyway, Uncle Vince is undeterred. He is going to chair a regulation reducing committee, and I'm sure this committee will, if it's like a star chamber, then hopefully, we'll get lots of ideas. And I think there's one thing that probably everyone in this room has noticed about this new coalition government, and that is we're not scared of being radical in the way that we look at things. And I think it's hugely, hugely important. And I'm particularly concerned about small business. The implementation of a piece of regulation takes 7 times longer in terms, or the cost is 7 times more in a small business. And when you're a small business person, as I have been in my background, you know, you've got so many things to do. Why on earth, you know, do we want to create pages and pages of complex, gold-plated regulation, which I'm sure are of great satisfaction and beauty to the civil servants who wrote them. But I've always said, you know, let's get these civil servants out from behind their desks, let them see, you know, what life in the real world is like. You know, at 10 o'clock at night, when your poor little entrepreneur's been on their feet all day, you know, maybe working in their shop, buying stock, cleaning, whatever it is, you know, and then they've suddenly got to start doing the paperwork. And one of the things that I'm going to be lobbying government for is for government to take a lot of that burden off. For some of the jobs that companies have to do, they're actually working as unofficial tax collectors for the government. And I honestly don't think, particularly in the context of small business, you know, that should be allowed. Small business is not a tax collector for the government, and there's a lot of legislation, I think, which is over the top for small business. You know, if you've got a micro business, you know, and you've got less than 10 people, there are important bits of protection which every single worker needs. No question, no ifs and no buts about that. But there's other stuff, I'm sure, that could be relaxed in the context of small business. So what are we going to do? Well, stuff I've been espousing for a while. This is so exciting to hear Vince Cale say, and this is what we're going to do. And I'm thinking, yeah. First of all, when we introduce a piece of legislation, one's got to go. One in, one out. Sunset clauses. Do we, you know, why don't we set a date to review that legislation sometime in the future to see whether or not that's actually going to be needed? And we've seen sunset clauses coming on 2 times already, so I'm very excited about that. And most important, and I don't think Vince has quite got this message yet, but he will, I promise, is when you're going to introduce a piece of regulation, then the idea is that you're supposed to do a pre-implementation assessment. In other words, say, will it work? What will it cost? Is it worth it? Can we do it in a different way? And if the answer to all of those is appropriate, then okay, go ahead, put it in. But then, why don't we do a post-implementation assessment? This was something I just banged on to the last government about all the time. You know, let's look at it in a period of time later. Did it work? You know, what were the unintended consequences? Do we really need it? So that's the sort of thing I think we've got to be a lot more sensitive. I'm sure this coalition government will never have an appetite for constraining either businesses or people. We don't believe in doing that. But where it's got to be done, then you know we will do it, but we will do it in a very measured and thoughtful way. I mean, business is the engine that's going to pull us out of recovery. So we've got to make sure that engine's well oiled, and you know that it actually is able to do that job, because all of our public services actually depend on it. And as you know, in the Liberal Democrats, we believe in top class public services. I don't let anybody say to you that we're enjoying making any cuts in public services. It's absolutely untrue. We want the money, we want it from business, so we don't want to hamper them with regulation. Thank you.
Very good. Thank you, Laura. It's an interesting view from the kind of deregulatory coalface. Before we go to questions, last but absolutely not least, we've got Patricia.
Thank you. Yeah, I was going to take a step back and look at some of the bigger issues facing the banking sector, given the huge amount of fallout from the crisis. If you look at the effects here and on the other side of the Atlantic, of course there's a massive focus on bank risk management, on bank governance, and there's a partner in Ernst & Young I'm very involved in trying to look at the systems in the banks, look at what went wrong and improve it. But I really wanted to look at some of the bigger issues that are being raised. Because of the magnitude of the crisis, people are starting to question issues like concentration in the industry. Certainly in the UK, the combination of HBOS and Lloyds has substantially increased banking concentrations. People are looking at the size of the players. The necessary rescue of a number of large banks has brought into question moral hazard going forward, issues in some countries like Switzerland about whether the banks literally are too large relative to the economy. There are questions about the range of activities that are undertaken by the banks. You've got Dodd-Frank's in America, which is actually putting limits on proprietary trading under the Volcker rules. Then there are issues regarding bonuses and incentives and bank taxes to claw back some of the costs. So I wanted to just look at a few of these issues. If you look at the issue of proprietary trading, the way it's sometimes discussed is in terms of turning back to very, very simple institutions, going back to almost Victorian banking. But actually banking has moved on a huge way. Even to run the most simple vanilla banking book, you need a huge range of instruments to actually hedge the different risks that come out of that book. That means that the firms have got to be heavily engaged in options and swaps and other derivatives just to manage the risk on a vanilla book. So actually drawing distinctions within the books about trading for hedging for customers, or trading on their account actually becomes very difficult and very complex. And if you look at Dodd-Frank's, there are a huge number of exemptions from the Volcker rules. So it is not straightforward territory. And I think you just cannot have in mind moving back to so-called vanilla banks, because banking is no longer really that straightforward. Even to manage the most simple mortgage book, you'll have caps and collars and options built into the structure of the savings products and the mortgages. Moving business wholesale out of the banking system also starts to create players that themselves are systemically important, and that too then creates further issues around other types of players that would need to be supported potentially. If we look at the issue of bank taxes and bonuses, I think, agreeing with the earlier speaker, this has got to be dealt with internationally. Ernst & Young carried out a survey of 38 of the largest banks for the IIF, which is a big international banking association. And I spoke to a large number of the CEOs and CROs in those banks. They, by and large, wanted to rein back bonuses. They, by and large, wanted to create more stability with deferred bonuses and so on. The problem is that there is no international approach to this. And if another bank moves in and starts pulling out whole teams with 50% joining bonuses, with a huge increase in structural pay, then they end up fighting back. And I think this is the question. How do you actually achieve, and is it possible to achieve, some sort of level playing field across the international financial system on some of these big questions? Because the banks in London are already coming under pressure from some of the American banks, bidding teams out yet again. And it's a pressure that is very difficult to withstand and maintain the business. If you look at bank taxes, the same issues are there, that you start creating distortions and driving business cross-border, driving the geographic allocation. The fundamental role of banks, which I think really hasn't been questioned really up until now, is also starting to come under question. You hear people talking about, well, actually, do you need banks to carry out this maturity transformation function that they carry out, borrowing short and lending long? Do you actually need that at all? It creates liquidity pressures in the banks. Why do you need it? And I really think, again, it's really worth understanding and thinking about the role that banks play in an economy. In the US, it's different. The role of the securities markets is much bigger, much wider. If you look at Europe, a consumer cannot get funding easily without going to a bank. A small company cannot access directly the securities markets. They need to go to a bank. They might need 7 or 10-year funds, and that means someone's got to do a maturity transformation because people won't place their money fixed for 7 or 10 years. So I think there is a fundamental role that the banks are playing that I hear being sort of questioned. If you look at international trade and the role that the big international banks play in those markets, providing complex hedging, complex instruments for financial companies, that too is an absolutely crucial role. And as you increase the costs for banking, so the costs of that role too increases as well. So you need the banks involved in international trade, you need them involved in corporate hedging. But competition in banking is really important. And I think one of the areas of the agenda which it is really important to focus on is how do you get more competition into banking. And if you look at the UK market, post the resolution of the crisis, it is a much, much more concentrated market because two big players have merged. So I think one area of focus is how do you get more players in and how do you get a wider variety of players in. Thank you.
Thank you, Joanna. Really interesting contributions, all kinds of quite different perspectives on the same set of issues here. Now, we've got time for Q&A. Laurie, I know you have to slip away in about 10 minutes' time. If you could just say who you are and where you're from, and also if there's anyone in particular you'd like to answer the question. Let's start with you, sir, and go second, go back.
I'm John Grout. I work for the Association of Corporate Treasurers, which represents the bank's wholesale customers, if you like. So you might expect me to take a particular view of banks. But I have to say, I've heard stunningly good sense from the table, and thank you for that. Two very short points, though. Dan Mobley mentioned rating agencies having a lot to blame for the crisis. But you were very careful to say for structured ratings, and I think it's very important to emphasize that. The rating agencies have a good record of rating companies, perhaps in rating sovereigns, but not in rating structured finance. And the difference is that the conflicts of interest are so much less. There are thousands of companies. There were only perhaps 18 originators of structured finance. The big ones were responsible for 80–90% of that, so 4 or 5 banks were being responsible for a huge percentage of rating agency income. And that's the conflict made manifest. Whereas for rating ordinary companies, no individual company, there's thousands of companies, no individual company is a meaningful share of the rating agency's income. And preserving that distinction in any changes in legislation that take place is very important. Secondly, there was talk about small companies needing bank finance. And that's true according to how you define small. But really small companies, the sort of companies with 10 employees, this sort of thing, are mostly unsuitable for having unsecured bank debt at all. They're very suitable for having some sorts of asset finance, leasing, that sort of thing. They're very suitable perhaps for having some sort of trade finance, and so on. But they're, by and large, speaking as a corporate borrower, they are unsuitable for unsecured debt. And that is something which politicians will break their spear on if they try and force them to do it. It will lead to a lot of unhappiness down the track. Obviously, there's some companies, particular circumstances, where yes, it is suitable, but for most small companies,
I think what we might do is take a couple of questions together. It's very, very interesting points, but good to gentlemen here and then.
David Bennett, someone who started a political journey in this party in 1981 with the creation of the SVP, and it's very nice to come to this point to see people actually sitting in government. It's been a long journey. I also, for my sins, am the chief executive of an organisation called Atkins, which is the Association of Private Client Investment Managers and Stockbrokers, which really are the people that look after private wealth in this country and investment in stocks and shares. And one of the biggest members is Rathbones, whose head office is at the other end of this dock. They've been here since 1742. They look after about £18 billion of money in this country. These firms are very important in the management of wealth in this country, but also putting investment into companies and firms. They're also a sector that, in the outcry against banks, are hit by every form of regulation. So, regulation against banks, we spend our life negotiating the unintended consequences away from our sector, and much of the time we don't. Anything that happens at the high street financial advisory end of the market, such as what's called the retail distribution review at the moment, we're also hit by. And the bureaucracy and the costs of that go up and up. And I think this is an area of fundamental concern that we touch on. There's some very good proposed regulation around at the moment. There's some incredibly poor regulation around. The Alternative Investment Funds Directive in Brussels is probably the worst, most over-politicised example that's come out of Brussels in living memory. There are major concerns amongst my association, but financial services in general, about the reform of the regulatory structure that you touched on. Philosophically, a consumer protection agency and an efficient market regulator don't philosophically join together very easily. And there's a conflict there which is not worked through the way the thinking is going in the Treasury at the moment. Now, this is open to consultation, but there are some very critical and important issues in that restructuring that's going on that this government needs to look at in great detail. Otherwise, we could end up with rather a mess and a very negative impact on the competitiveness of all of our financial services in this country. The other thing that concerns me at the moment, we have a regulator on the defensive, and because they're on the defensive, there are many areas where they are constraining innovation. And one of those areas will be to push people into what are known as model portfolios and away from investing in risk, which are the small companies in this country. And that's an issue of concern.
Okay, I think we'll cut things there to get some responses from Madam Laurie. You've got to go first.
Yes, please. Yes, and with apologies to everyone that I can't stay right till the end. John, we met yesterday. I will break my spear on unsecured bank debt for small businesses. I mean, I just think that, forgive me, I've been a small business myself. I don't understand the difference between the fact that you're a small business, that you shouldn't, somehow you're not good enough, to be allowed unsecured bank debt. And don't even get me, I can't even start going there on bank lending to small businesses, because I think what's going on in this country today, not just in terms of reluctance to lend, but in terms of rates that they're imposing, and even more in terms of the actual cost to any business of borrowing all the fees, the arrangement fees, etc., etc. You know, I just think that they deserve a better deal, and if we can't give them one as a government, I think it's a pretty poor show. So yeah, my spear's ready. I've got it at the ready, and you know, we'll have to argue the toss on that one. David, all I would say, you make some very, very knowledgeable points about the possible unintended consequences of regulation which is being considered. Please do feed it to me. I chair the Parliamentary Party Biz Committee. We meet with the Treasury Committee every other week, and this is something that we can certainly put in front of them to colleagues who are a lot more knowledgeable than I on these matters. So thank you very much indeed for that contribution, and please do that. My email for anyone who wants to email any great ideas of what we should be doing is just burtl@parliament.uk. So it's just surname, initial @parliament.uk. I'm really sorry I've got to go. It's been a really interesting and fascinating. I've learned such a lot this lunchtime. You always know, you think you know something about a subject, and then you meet someone, you realise how much you actually don't know. So very, very grateful for all of the fantastic contributions.
Brilliant. Pleasure to have you here, and good to end on that interactive note so you can all make contact online. So there were a range of different points again out of those two contributions. I don't know if any of the other panelists want to pick up on. Somebody's spoke about segmentation of different parts of the industry, or.
But perhaps I could just pick up on the rating agency one. I honestly don't think we can get the rating agencies out of the financial industry. The search costs for individual investors in investing in products are just far too high, and the ratings will always be used. I think the question is more what kind of processes the rating agencies have within them. I chaired something, a global working group to look at what went wrong in the securitization markets for the IIF, and had the rating agencies, the investors and the banks on it. And the recommendation the IIF made was that the rating agencies should have the same systems around their model validation, data and so on that the banks did, that they should set up some sort of SRO system and have as a self-regulatory organisation for the rating agencies. And I just don't think any of the legislation that's coming out on rating agencies has actually picked that up.
What did you think of Dan's point about trying to end the conflict of interest around the issue of paid ratings?
I just don't see what the solution is, and we did look at this issue of whether they could remunerate them in a different way. Very, very hard to do it. We need to get the securitization market going, and again, with a very, very vanilla product, with many more safeguards, but I don't think you will get the ratings agencies out of it. I just think you've got to have more protections around how they are doing the risk management inside the rating agencies.
And do you disagree with that? You think it is plausible to try and...
I think
who's going to pay for all this?
I think on the structured finance side it is perfectly possible. I mean, as you say, there aren't many people issuing them, and you can ask the investors to look at them. I mean, this kind of crazy comments you heard during the crisis that people were trading stuff they didn't understand. That's kind of mad. I mean, I'm happy to look at other ways in which you could actually regulate the CRAs more tightly, and I'm sure there's plenty of other ideas out there, but on that sort of narrow particular band, I think we could look quite carefully at prohibition. But I wanted to pick up one of the other points, and it's probably good that Laurel's left. I think I'm about to impale myself on her spear. But it's the point you've raised actually, John, around SME lending. I mean, we don't do small business lending in the UK, but we do it in most countries where we operate, and there's some interesting lessons from it. But the one thing, I mean, small business lending is very heterogeneous, very different from country to country. But one thing you can say with certainty is that it's one of the riskiest forms of lending you do as a bank. And in recessions, that's usually the first part of your loan book that goes bad, turns sour, and you lose lots of money on it. So compelling banks here in the UK to extend credit to small businesses that are not creditworthy just doesn't make sense. And I think politicians need to recognise that you can't say to banks, clean up your acts, stop lending stupidly, stop encouraging people to borrow who shouldn't be borrowing, and then at the same time say you must lend to every small business person who shouts at my MP surgery or at my political ministry. It just doesn't work, and we need to think through. There are some things that can be done, but the UK is quite unusual in SMEs in that we historically have tended to use overdrafts to finance small businesses. And that's actually a very unsuitable form of finance in many cases. And a lot of what we're seeing at the moment is banks trying to migrate small business customers onto more appropriate types of lending, trade finance being a very good example, that's a bit more sophisticated. And I think the banks have been quite bad at explaining that and getting that message across to their customers as to why this is happening and what's happening and what products are suitable or not. But we shouldn't kid ourselves. The direction of regulatory travel, the things that are necessary to prevent future crises, higher capital levels, restrictions on and better regulation of liquidity, taxes on banks and so on, will reduce the amount of credit and they will make it more expensive. And that will particularly be true of the riskier parts of your loan book, and that is small business. And you simply cannot say we want clean, good banks, and at the same time let's lend to every small business here. It just, the two don't add up, and we see that in any country. It's not just a UK thing.
Just a postscript on the small businesses, if I might. We run Business Deadline, so helping small businesses, as it says on the tin, in financial difficulty. I think I'd take a bit of a middle way there, because actually, I'm not sure, John, that I completely agree with you that, no small business, or you didn't quite say no, did you? But the vast majority of small businesses with 10 employees or under isn't suitable. But what we do find is, and this picks up on Dan's point, there are lots of small businesses who need finance, but don't actually know any other ways of accessing finance. And one of the things we're able to do as part of the process is to educate them that there may actually be better ways. So then you get away from this, sort of dialogue of the deaf, as it were, about politicians shouting over here and banks shouting over there. So I think there's a job to do across the sector, which is about actually education for those tiny businesses about what's available and what's appropriate for them.
Can I just comment on political?
Just a moment. There's a lady who's been waiting very patiently. So we'll come to you in a second.
Kate Gordon, I'm a candidate for Bath Region Scottish Farmers. I'm just wondering how much evidence there needs to be anecdotally before it becomes accepted that actually it's not just small businesses that are about to go to the wall, it's small businesses that are viable, that have been banking and had a very good track record for years and years, who are suddenly finding that they have to renegotiate their credit terms, or they have to. I've been speaking to the Chamber of Commerce in Glasgow, and they have evidence of banks pressurising surveyors, for example, to mark down property prices, so that therefore, if you're going to seek finance, you've got higher charges. I mean, these are not just. They're not businesses that are falling apart. So I do think when banks are saying we are lending and it's only, I think that's a bit unfair. What I really wanted to ask you, actually, Dan, was, and I wish Naomi was still here, is so what you're really saying about the retail and investment arms and breaking them, the whole debate around breaking up the big banks, you're basically saying that's the wrong way to go around it. And I kind of wanted to get you and Laurie into more of a detail about whether she has heard you, you're basically saying the government is wrong about that and it's not going to make any difference whatsoever. So could you elaborate a little bit on that?
Sure.
Yeah, no, very much.
I mean, just very briefly on the SME thing, I think, the evidence base is an interesting question, and there's no doubt there will be some viable businesses that are struggling to get finance in the UK. I'm not a huge expert because we don't do retail banking in the UK, but there is a study going on at the moment between the government and the banks, which is led by the British Banking Association, to try and get, to cut through this dialogue of the deaf and see what more could be done either jointly between governments and banks to make sure credit lines are there, and also the education piece I mentioned about what kinds of finance are available and what's the most suitable. But again, I just don't think we should kid ourselves that if you want banks to be more stable with more capital and manage liquidity in a different way, there will just be less credit around, and it will cost more, and that's going to hurt, and that's going to be part of the deleveraging, the moving of debt from Western economies that are over indebted, and it is going to hurt ordinary people. It will hurt people trying to get mortgages, and it will hurt people trying to run small businesses, and indeed in some cases large businesses. So we just kind of got to accept the next 10, 20 years are going to be quite nasty in terms of access to finance in many Western countries. On the splitting up banks thing, I mean, it's quite interesting. On the one hand, I mean, Laurie made a very fair point that the government isn't rushing ahead with this. They've set up a commission with 5 very eminent people who are pretty impressive to look at these issues, and the first thing they're doing is hauling in the bank CEOs, so I'm very busy writing briefing papers for them to kind of understand the arguments, and they'll speak to a range of academics and others to try and understand. It is a bit of a problem because it's creating a lot of uncertainty for the industry, which again is a little bit unhelpful if you're thinking about your long-term plans for the kind of business you're going to run in the UK or elsewhere, but that's something we have to live with. I think it's interesting that the only countries that are really seriously examining this question of whether to split up banks from the retail and take out the investment side, apart from the UK, are actually Nigeria and Zimbabwe. And I just make that point because it's just not a live debate anywhere else. If you travel a lot, as I do in my job, and you go into Asia, go into China or India or Korea, you can go to the US, they're not talking about setting up that kind of system. And the reason I would say why is something I touched on very briefly in my speech, which is simply no evidence that it makes the system more stable. We saw very narrow small banks fall over a lot in this crisis, North Rossensville. We saw investment banks, pure investment banks, fall over, the likes of Bear Stearns or Lehman Brothers. They were entirely separate, so it's not clear that would stop that happening, and they had system-wide impacts, and they took other banks down with them in some cases. And I say actually, in many cases, it was the broad universal bank, so Standard Chartered being one that does both commercial banking and retail banking around the world, or HSBC are our great rivals. I hate to use a four-letter word again, but the very broad universal bank that came through the crisis with great stability and without experiencing loss, because they had this broad base of activities, and where one part of the business might take a hit, the other bit was able to stabilise it. So I think we should be quite careful and compile the evidence base, and if someone can show some evidence that this would help, fine, but we haven't seen it yet, and I'm not sure it will get to the Commission.
I feel like I should plug this book, our recent paper on how a different way of incentivising borrowing banking, not a Glass-Steagall style structure, a different type of product rather than type of institution. Did you want to? There seems to be there's two different questions about firm size. There is a question about Glass-Steagall type concerns and whether you can run these giant city type institutions. And then there is a set of issues which are really about concentration in particular markets. For example, the UK, where we have a very small number of players now. We always struck me as rather difficult to prove that there was excessive concentration, because you could look at the great returns that these players were making in good years. But of course, that would theoretically have been wiped out by the fact that we've got bust. And so it's very difficult, given the intervention that we had to have, to sort of get a sense of whether it is an over-concentrated industry. I don't know if you have any view on that.
I do think that the solution to the HBOS issue of combining HBOS and Lloyds did end up concentrating the UK system yet more. There are players that are considering coming in, and in fact, a couple have already come in to specialise in the whole SME area. And so a number of players are sort of looking at the market and saying that there are niche SME products which are not really being offered, and they want to come in to offer them. It is quite difficult, of course, to establish a bank because of the capital and the liquidity requirements that you need to have. But there are definite players coming, of course, Virgin have come in with their small bank. There's a private equity house which has come in with a bank Alderman. So we are seeing new entrants. And I just think you need a wider range of different products. And if you look at the German market, the role that venture capital has in providing funding for small companies is really, really important. And one of the big questions has always been, why hasn't that sector really got underway in Britain? And the role they play is different. It isn't just funding. They actually go in and almost provide a management consultancy, because they lean over the shoulders of the owners of the business and provide advice about how they improve their market and their marketing and the business with us. And that's never really gone underway in Britain. And I think one quite important question is, isn't there a role for something that's kind of different from traditional finance?
Interesting. I think we've got time for maybe just a couple of last questions before we finish up. So we'll take maybe these three together. So Lisa, and then here, and then.
Just a quick one. Brian Ted from Sovicar. The point I would make is that with regards to bankers at the moment, Parliament has lost control of the bankers. They lost control of the trade unions before this. They lost control of various other things over a period of time. You have to go, a political will is needed to sort the problem out. The trade unions said there was no solution to what they were doing. They were right. Everything was right about it. They were asking for more money, over-inflation driven. Same thing that you're saying there. Our bonuses are correct. We can't not have these bonuses because people go elsewhere. And I understand you make a very, very good case around that. But politically, to the ordinary person, this is just plain wrong. They also go, I think the point that you make as well, you're saying there, the ordinary person can't understand the product that some of these finance people are selling. And I suggest to you that they're making it like that, so that people can't understand quite how it all works. And because you go into a bank and you find even the employees don't know how it works properly to explain to it on occasions. So again, it's this fuzziness that Parliament will come, and you're seeing Laurie there saying to you, this isn't good enough. And eventually, it'll take years, but eventually somebody politically will come along and come with a solution for this. And I'll just put that point to you, that this is a political problem, exactly the same as the trade union, but in a different style. Bankers have got bigger control than Parliament because you're a worldwide organisation.
There's another question here.
Peter Barnes from Cleveland Associates. As we've heard from the panel, the UK authorities have been much more aggressive than most other countries internationally in their attitude towards the banking sector, whether it's in terms of regulating compensation or in terms of things like the bank levy, which is both earlier and greater in scale than other countries do something similar. Do you think that, from your interaction with the UK authorities here, that their position is that they are they don't care about the international repercussions, the sense that your teams can be poached in other jurisdictions, that the sort of Turner view, if you like, that competitiveness is not something that should matter very much? Or do you think it's that they don't accept that the actions they're taking do actually have an international impact on competitiveness?
So we have sort of two sides of the same coin there, those two questions, and then the third one.
Yeah, I guess I'm sort of James King. I've worked for the financial services sector, but speaking here as a Camden Liberal Democrat, we're speaking about the politics and banks having appeared to just got out of touch with local communities, and actually to some extent maybe they stopped understanding the risks and doing basic banking models as it got more and more global investment banking. And I think we do need to have a debate, because there is an opportunity here with the banks having been nationalised, about what sort of banking structure and model that we want that brings us back to having more of a community connection. Because at the end of the day, banking is a utility for every individual and small business, and there is, and I personally, I don't think the sector gets it yet. There's a degree of public anger that there is about the consequences we're seeing through the public sector of the recession that was started by the banking crisis. Now, some of that stuff is of course simplistic, but I think it's really going to matter in terms of the evolution of this debate in the next few years.
That last question maybe we might throw over to you, Joanna, as a sort of out of touch with the community.
Yeah,
sort of point.
I think there's a thing, isn't there, about big organisations, whether they're a bank or whether they're a government department or a local authority or whoever they are, and it's very easy to lose touch with the people on the ground, because you get caught up in the big things, and you get caught up in your accountability and your governance and your profits and all that sort of stuff. And I think that, those things can happen. Sometimes technology can be the cause of that, or at least can exacerbate that. So you start to rely more on what the technology tells you than what your bank manager on the ground might have told you in the old days. And I don't want to sound like I want to bring back Captain Mannering, because I don't think the clock is ever going to turn back in that way. But I think there is a trick here, which is about, we're seeing this with some of the banks, which is actually getting the technology to work in your favour, to bring back the connection with the community. We'll give you a number of examples, but one that's quite important, I think, in my area is actually helping to work out who is going to get into financial difficulty before they do, insofar as you can do that. So using the technology to work for you, perhaps in the way that Captain Mannering did in the past, where he knew the people, and we all accept that's not really possible these days, but you can use the technology in order to make that connection, and then you can use a human, you can then make the connection, say, and lots of banks are trying this now, phone people up and say, actually, it looks like there's a problem here, can we help you, can we put you in touch with people who can help? So I think there are ways of getting past it. I think any big organisation is in danger of doing what we've just said has happened. But I think you can find clever ways of getting past that and getting back to that sort of community connection.
The idea of a sort of virtual captain manner of things, but interesting concept. This point about remuneration, you heard both sides of the story there. The anger that there is, and also the fear in the industry of people all being driven out of Britain. Who wants to go first?
I can have a first crack. I mean, I think Brian and Peter have sympathy for both arguments, even though there's obviously tension between the two. I think the sort of astronomical sums that some bankers receive are just very hard to explain. I think there are good and bad reasons why bankers earn that much money. There is, your star performers, your rainmakers, there are only a handful of them. Most banks just make such stellar returns. Now, there's a big question about, are they making those stellar returns by doing the right thing, or are they taking unnecessary risks that will cause catastrophe? And obviously you hope it's the former, not the latter. And when you leverage that up with technology, those people just become incredibly valuable. And so the average pay in my bank is $40,000 US. We don't get anything in dollars, which obviously is slightly above the average wage in the UK, but that's because the vast majority of our staff are, bank tellers out in Singapore or Nigeria or wherever. But there are a handful of extremely well remunerated individuals, and the challenge is if we don't have them, we won't make the profits that we make, and we won't remunerate our shareholders. But to kind of explain why these people are making that much money is very hard to bring about. And there are also some bad reasons in that, banking as an industry, there's nothing comparable except possibly Premiership football, where the employees take a very, very significant slice of the profits. It's very unusual. In a normal industry that functions in a normal way, competition would eat away at that.
Yeah.
And as our CEO always says, I don't, hurts me slightly, but I don't want to pay my staff any more than I have to. And it's true. But he's competing, and you have this kind of crazy game where bankers are paying ever larger sums than people just get these kind of range makers.
I think you'd be fine. That is the point Laurie makes. The ordinary businessman, they're not getting their money, and you give them good reasons for that as well. And you give good reasons to pay millions of pounds, and I agree with you, you can't do any different. And I agree with you, it's very difficult on the other piece. What I'm just saying is politically, there's going to be, at some stage, somebody's going to come along and say, not to the money, it's going to be around the other piece, those small businessmen that Laurel is making the point saying, do it.
I think we're heading into a political nightmare. And personally, I think if we can create a system where banks are able to fail, and if we can increase competition, then over time, like a normal industry, you would see some of that sort of the rents being captured by bankers, these giant bonuses be shrunk, but it was quite a long time. It's quite hard to do because if you increase competition, you can also increase instability.
Wants a solution, not so much for the millionaires. Her solution she wants for those people, not for you to say you can't do it, but what is the solution for them? I know you can't answer that today, but that's what she's asking to do. If you give her that solution, then she'll be happy, and you can have as many millionaires as you like and be one yourself. But that politically, at this moment in time, the banks need to work out how that can be done. Obviously, you get credit unions, don't you, for individuals, if you follow me. Can the banks do something to help? And there was investors in industry came together, didn't they, with the big 4 or 5 banks, obviously, to loan money there. And understand exactly technically why you can't do it. But the point is, it's the same way as technically the trade unions thought they were right. And the politicians come along and say, no, you're not. That's only the point I'm making. Some effort needs to be made.
There's the sort of interesting question you raised there, which is, as you said, competition should eat away at this. And it's interesting. I asked lots of economists this question: why are bankers paid so much? Why do wages in the industry as a whole stay so high? And it feels like a lack of competition of some kind must be part of the answer there. I don't know whether you have a view on either that question or this point about how far you can go in terms of changing remuneration in one country without losing competitiveness.
I mean, I think the bonus issue is about either a perceived or actual shortage of particular skills. And we're seeing it right across some of the disciplines at the moment. In fact, we are being hit as a firm by people trying to pull our teams out, either the other big 4 or the banks. And it's because there just aren't the volumes of skills out there. And but I think on this question of the international level playing field, that there is a dimension to this that people just don't kind of talk about at the moment, which is financial services for Britain has probably been our most successful industry. And yes, we've been through a huge crisis, and there's this issue about the kind of domestic banking sector, but of course London is a massive international financial sector, and the huge number of very large institutions. Now, yes, to a degree that fell back on us a bit during the crisis, or more than a bit with the Icelandic banks, some of the fallout from Lehman's. We probably would have got some of the fallout from Lehman's even if we hadn't been an international financial centre. But I just think it's a pity to lose sight of the fact that that industry for Britain has just been a huge success story. And the interconnection between all the firms in London, the lawyers, the bankers, the insurance market, has been a real powerhouse. So I think, you know, that does need to be taken into account. If you go your own way as a country on bonus taxes, on bank taxes, that's going to start to unravel. I mean, I've heard real fury in some of the overseas banks over the bonus tax and the implications, and people are looking at moving to other areas. Now, the hassle of moving will deter people for a few years, but a lot of people have looked at it and they've said, well, actually, in 3 years' time, we really will revisit it. And I think, given the size of that industry, and over a long run, the huge benefits, actually, of having it here, I do think that needs to be thought about a bit.
Very good. And again, another shameless plug, there's something piece of work done on relatively soon, looking at whether people are moving, and if so, why. Joanna, Patricia, Dan, brilliant contributions. Thank all of you also for your very, very good questions. It's been an interesting discussion. I have a lot of notes to take away and think about here. Good discussion. It only really remains for us to thank you the traditional way.